Morning, sir.
Right. So you can remember. So last time we adjusted the financial statements. You see tutorial number 4. Then we have reformulated. We have reorganized financial statement items to suit our analysis. Right. Now you see these are reformulated financial statements. So here what happens is we have reorganized financial statement items for a better analysis. Right. So we have reorganized the statement of income and statement of financial position. Right. Now we can start the analysis. Now accounting analysis completed. We completed the accounting analysis. Now we can move on to the financial analysis. Right. You can remember, you can apply ratio analysis. To do a financial analysis. In addition, you can apply common size analysis, trend analysis. So depending on your analysis purpose, you can choose appropriate method or methods. Right. Now we'll first apply ratio analysis. You can remember we can apply ratios to do a credit analysis, profitability analysis, and to do valuation. Right. So this valuation part you'll be learning in other courses like business valuation, corporate finance, sometimes in financial modeling forecasting subject. Right. Now we'll do first profitability analysis. Right. You can remember, we focus on return on assets. Then you can remember company's operating performance and assets utilization efficiency affect your return on assets. So your profitability analysis, you can start with analysis of return on assets. You can start with the analysis of return on assets. Right. Now first we'll calculate the return on assets. Then we can analyze. How this return on assets has changed from 1 year to the next year. Now these points we studied earlier. And the analysis tools we studied. Right. Now we'll first calculate return on assets. Right. So hereafter now we are using reformulated financial statements. Right. Now you have these financial statements. So last time we completed. So we'll have separate Excel sheet. Right. So we'll say this is profitability analysis. Profitability analysis. So you can name this sheet profitability analysis. So we have 3 years. You see 2019, 20, and 21. So in this worksheet, the first column for the ratio name and the next 3 columns for the 3 years. Next 3 columns for those 3 years. Right. Now we are doing a profitability analysis. So calculate first return on assets or return on investment. Return on assets. So calculate return on assets. Right. So you don't need to write the formula. You know the formula. Now you can quickly calculate. You know return on assets equal operating profit divided by total assets. Operating profit after tax divided by total assets. Now we have these values in the reformulated financial statements. We have these values. Right. So equal. You move on to the reformulated financial statements. Now these are the reformulated financial statements. You see operating profit after tax. You see operating profit after tax. Right. Divided by total investment in assets. So investment in operating assets, you see in the statement of financial position, investment in operating assets, 7,170. Right. So operating profit after tax divided by investment in operating assets. Investment in operating assets. Right. So return on operating assets. Return on operating assets. Then you can drag these to the rest of the sales. Right. So you can make these two percentages. You can make these two percentages. Under formatting, percentage. So you can take up to 2 decimals. 2 decimals. Right. Now you see a return on operating assets. Now you can check your answers. So you have reformulated financial statements. Now you can check your answers. Now if you have any question, you can ask, right? You can interrupt me and ask. Right. Now you see 2019 return on assets, almost 29%, but 2020 declined to 16%. When it comes to 2021, it further declined to 12%. Right. So when you do assignment, you might explain this. Return on assets declined to 16% in 2020, and it further declined to 12% in 2021. So this is not analysis. Remember, explaining the changes in a ratio is not analysis. Right. Explaining a change in a ratio is not analysis. Now that you have to remember. The analysis is finding the reasons for the change. Analysis is finding reasons for the change. Right. So I am going to see very carefully whether you have done an analysis or not in your assignments. Right. So if you have just explained, for example, a change in the ratio, that's not analysis. So we studied those points in the analytical analysis tools lesson. Right. Now you see return on operating assets is in a declining trend. So you have to find out why this has happened. Return on operating assets is in a declining trend. So you need to find out why this has happened. So that's analysis. That's analysis. Right. You can remember we studied return on operating assets is a product of operating profit margin, and asset turnover. Operating assets turnover. Return on operating assets is a product of operating profit margin and operating assets turnover. Right. Now you calculate operating profit margin. Operating profit margin. Operating profit divided by sales equal in your reformulated financial statements, operating profit after tax divided by sales. Operating profit after tax divided by sales. You see operating profit margin. So you can make two percentages. Right. Then operating assets turnover, sales divided by investment in operating assets equal in your reformulated financial statements, sales divided by investment in operating assets. Sales divided by investment in operating assets. This is not a percentage. Right. This is a number of times. This is a number, not a percentage. Right. Now, if you multiply these two, you get the return on operating assets. Let's see this. Operating profit margin multiplied by operating assets turnover. So you get a return on operating assets. You see, you get a return on operating assets. Same answers. Same answers. Right. Now you see the changes in operating profit margin and changes in operating assets turnover. You see operating profit margin. Now we'll see the changes from 2019 to 20. You see changes from 2019 to 20. These 2 years. Operating profit margin declined from 22% to 17%. Assets turnover declined from 1.31 to 9.96. Now you see decline in operating profit margin and assets turnover resulted in decline in return on operating assets. Right. Now you see two major reasons for the decline in return on operating assets from 2019 to 20 is decline in operating profit margin and decline in operating assets turnover. But if you see 2020 and 21, you see 2020 and 21, operating profit margin almost same, but asset turnover decline. You see, operating profit margin almost the same, but operating assets turnover decline. So as a result, return on operating assets declined from 16% to 12%. Now you see from 2020 to 21, the major reason for the decline in return on operating assets is decline in assets turnover. Decline in the efficiency of using assets. Decline in the efficiency of using assets. So when the assets efficiency decline, then what happens is your return on operating assets decline. But from 2019 to 20, return on operating assets declined because of these two major reasons. Decline in operating profit margin and decline in operating assets turnover. Now we'll have to find out the reasons for the decline in operating profit margin and reasons for the decline in operating assets turnover. So what has caused for the decline in the operating profit margin and what has caused for the decline in the assets turnover? So that's the analysis. Remember, in your assignment, just explaining the ratio is not analysis. Finding the reasons for the changes in the ratio is the analysis. Right. Now we'll first find out the reasons for the decline in the operating profit margin. So you can do a common size analysis for your statement of income. You can do a common size analysis. Then you can find out the reasons for the decline in operating profit margin. Right. You see in your statement of income, right? You take the operating items in your statement of income. You take these operating items. You can copy and paste. You can copy and paste here. Right. You can copy and paste here. Now you do a common size analysis for these items. We studied. Quickly do a common size analysis for these items. So sales are 100. You know sales are 100. In your common size analysis, sales is equal to 100. Then proportionately you calculate the rest of the values. So quickly do a common size analysis. Quickly you do a common size analysis. Right. Sales is equal to 100. Right. Do a common size analysis. To calculate the common size amounts for cost of sales, gross profit, administrative expenses, distribution costs, likewise all these items. So this 100 divided by sales, 100 divided by sales, multiplied by cost of sales. So we studied those things. So that 100 divided by sales value multiplied by cost of sales. So you get the common size value of cost of sales. Right. So we'll round up to 2 decimals. We'll round up to 2 decimals. So then what you do is you fix these $100, B8, so you fix the row number. You fix the row number. Then you can copy this formula to the rest of the cells. Right. So these are the common size amounts. Right. You can check your answers. Right. Now you see the last item. Common size amount for operating profit after tax. So that's operating profit margin. 22.03, 16.99, 16.99. So that's operating profit margin. Right. Now you can find out from this common size analysis. So you can find out. So what has caused for the changes in operating profit margin? What has caused for the changes in operating profit margin? You can easily find out. Right. Now let's see 2019 and 20. Let's see 2019 and 20. Operating profit margin declined from 22% to 17%. You see, from 22% to 17%. So what are the reasons for the decline? What are the reasons for the decline? You see here, cost of sales, common size amount is the same. Both years, cost of sales, common size amounts are the same. Therefore, gross profit, common size amounts are the same. The meaning is the company had same gross profit margin in both 2019 and 20. Company had same gross profit margin in both 2019 and 20. So gross profit values are the same. But you see, expenses have changed. You see, expenses have changed. You see this? Expenses have changed. The administrative expense proportion increase. Administrative expenses increase relative to sales. You know, usually we expect administrative expenses as a fixed cost. Usually we expect administrative expenses as a fixed cost. So what does it mean? The expense amount should be same. Expense amount should be same at different sales volume. Usually administrative expense is same. It's a fixed cost. Now, if you look at the financial statements, you see financial statements. 2019 and 20, you see the sales value. Sales value has gone down. You see sales value has gone down. And administrative expenses have increased. Administrative expenses have increased. You see two values, 1728 in 2019, but 2020, 2162. Now you have to study why it has increased. You have to study. So if you are an internal analyst, you can discuss with company management. There could be unavoidable increases. There could be unavoidable increases. For example, due to changes in the utility rates, water supply rates, electricity rates, a company has to pay more for utility expenses. So those changes we cannot avoid. Sometimes company has moved onto a new office building. The old office building space is not enough. During 2020, company, for example, has moved to a new office building. Then for the new building, company has to pay higher rent. Company has to pay higher rent. Then what happens is your administrative expenses goes up. So you have to find out, if you are an internal analyst, you can discuss with relevant personnel in your company. You can find out. So what factors have caused for the increase in administrative expenses? What factors have caused for the increase in administrative expenses? Even if you are an external analyst, you can request further information from company's management. Now, these are summarized financial statements. You see, these are summarized financial statements. But you can request from management details of administrative expenses. So how these two values are made up in 2019 and 2020. Right. So from these additional information, you can do a detailed analysis. Now we found one reason for the decline in operating profit margin is increase in administrative expense proportion. Increase in administrative expenses. In addition, you see, distribution cost proportionally increase. You see, distribution cost increase. 2019, as a percentage of sales, it's 6.2. 2020, it's 8.49. So distribution cost increase. Distribution cost increase. Right. So again, you have to find out. So why this has happened? Why this has happened? If you see the values, you see sales decline. You see sales decline, but distribution cost increase. Distribution cost increase. Right. Now you see your further analysis. You found with your further analysis, the two major reasons for the declines in operating profit margin is increase in administrative expenses and increase in distribution expenses. Now you have to do a further analysis. You have to do a further analysis and find out why these two have increased. Why these two increased from 2019 to 20. So you have to do a further analysis. Right. So these two areas you have to pay special attention when you are doing a more detailed analysis. Right. Any questions? Any questions? Right. Then see 2020 to 21. You see operating profit margin all same. Operating profit margin same. Right. Now, if you see this common size analysis, you see a gross profit level increase. The gross profit common size value increase. You see 2020, 56, that increased to 57.54. Right. So this is favorable for the company. This is favorable to the company. Right. Company has been able to lower cost of sales in relation to the sales. Company has been able to lower cost of sales proportion relative to sales. So company's gross profit margin has gone up. Gross profit margin has gone up. So this is favorable to the company. You see administrative expense proportion decline. So usually that doesn't happen because administrative expenses are almost fixed cost. So if you see the financial statements, you see sales increase, administrative expenses increase. That's why I'm telling you, when you are interpreting ratios, you have to be very careful. When you are interpreting ratios, you have to be very careful. Right. Now let's see a very simple example. Now let's see 2 years, 2020, simple example, 2021. Now let's say administrative expenses of these 2 years, same. For example, let's say 1,000 and 1,000. Because administrative expenses are almost fixed cost. Many administrative expenses are fixed cost. Now let's say sales 2020 10,000, 2021 12,000. Now calculate the common size of value. Administrative expense divided by sales. Now sales is 100. Let's see the common size value. Sales is 100. Sales is 100. Then common size value for administrative expenses equal 100 divided by sales multiplied by administrative expenses. 100 divided by sales multiplied by administrative expenses. How much? Common size value is 10. 2021, common size value 8.3. 8.3. Now you see, administrative expense proportion decline. Administrative expense proportion declined relative to sales. Administrative expense proportion relative to sales decline. So that happens when administrative expenses are fixed cost. You know, fixed cost is almost same whether sales increase or decrease. So fixed cost doesn't increase proportionately with the sales. You study those cost behavior in cost and management accounting. So fixed costs almost the same whether sales increase or decline. So when sales increase and fixed costs same, what happens is the common size value declines. Common size value decline. So when fixed costs same and sales increase, you see common size value of administrative expenses declines. Now you see administrative expenses same in both years. But sales increase. Then what happens to the common size value? Common size value declines. So that doesn't mean your administrative expenses have declined. So this happens when administrative expenses are fixed cost. Because your expense is almost the same in both years, but sales has gone up. Then you see common size value declines. So this kind of behavior we expect from administrative expenses. Now you see the financial statements. You see 2020-21. Administrative expenses almost same. There's a slight increase. But sales has gone up. Sales have gone up. Administrative expenses almost the same level. There's a slight increase. But sales value has gone up. Then what happens to the common size value? Common size value declines. Common size value declines. Common size value declines. Right, now you see administrative expense common size value 23.25 in 2020. That declines to 20.25 in 2021. So this happens for a fixed cost. So when you are interpreting these analysis results, you have to be very careful. You can't say this is favorable to the company because common size value decline. You see administrative, if you look at only the common size analysis, you find administrative expense proportion decline from 2020 to 2021. Then you cannot move on to explain and say this is a favorable. This is favorable to the company. So that's wrong. You have to see really what has happened. Administrative expenses are fixed costs. When the sales increases, what happens is common size value declines. Common size value declines. So remember, you have to be very careful when you are interpreting the results. Right. So usually we expect this kind of behavior. Then you see distribution costs. Distribution cost level has gone up, slightly gone up. If you see the financial statement, sales has gone up. So we expect distribution expenses to increase. So when the sales goes up, we expect distribution expenses to increase. But here we find distribution expenses as a percentage of sales. Now this common size value is distribution expenses as a percentage of sales. You see, it has gone up. It has increased. The meaning is you may have spent for additional expenses that have not been incurred in 2020. So your increased sales as a result of certain additional distribution activities that have not been in 2020. Your financial statement says that increased sales in 2021 is as a result of certain additional selling distribution activities that have not been in 2020. Now you can discuss with management. What are those additional sales, promotion, distribution activities? And find out whether those additional activities, new activities, has brought new sales to the company. Those additional distribution activities, whether those additional distribution promotion activities has been able to attract new customers to the company. So you should evaluate the effectiveness of those additional selling distribution activities. So that's the analysis. That's the analysis. But for your assignment, you cannot do that. Right? But you can suggest these further analyses are required. Right? You can suggest based on this analysis, these further analyses are required. Right. Now you see, gross profit margin has gone up. You have spent money for certain additional distribution activities. And there are some other expenses that have not been in 2020. You see, there are certain other expenses that have not been in 2020. Now your increased gross profit margin has been compensated by these additional expenses. You see, gross profit margin increase, your distribution expenses increases, and you have spent money for additional other expenses. You see, other expenses in 2020 0. It's 4.5% of sales in 2021. So as a result, your EBIT same. EBIT same. Then operating profit after tax, common size value same. Right. Now you see, if you see the operating profit margin, 2020 and 21, there's no change. That doesn't mean you don't need to analyze. So when a ratio has not changed from 1 year to the next year, it doesn't mean you don't need any analysis. So you have to analyze. You have to analyze. Now you see, even your operating profit after tax, common size value, operating profit margin has not changed. You see, your analysis find that the company has been able to increase gross profit margin. That because of lower cost of sales. So this is a favorable point. So this is a good point. And company attracted new sales. Company attracted new sales with certain additional selling distribution activities. Right. Now you see, even the ratio has not changed. You need analysis. You need analysis. Right. Now you know the reasons for the decline or increase in decline in the operating profit margin. Right. So with this common size analysis, you can find it out. Right. So major reasons I have highlighted here. So those major reasons, you see I have highlighted in yellow. Right. So this is about operating profit margin. Then we'll analyze operating assets turnover. We'll analyze operating assets turnover. Now you see turnover ratio has been declining. You see turnover ratio has been declining. Right. So you should analyze what has caused for these declines. What has caused for this decline? So in your reformulated financial statements, you can see the assets. You take all the line items of these assets, investment in operating assets. Take all the line items of these investments in operating assets. Investment in non-current assets and investment in working capital. So you can copy here. You can paste here. You can paste here. Right. Now we are analyzing, we are going to find out, we are trying to find out the reasons for the decline in operating assets turnover. Right. Now we have the operating assets items. Then calculate turnover for each item. Calculate turnover for each item. Equal, you know the turnover calculation. Sales divided by asset value. Equal sales divided by asset value. So in the reformulated financial statements, sales divided by asset value. Sales divided by asset value. So you get the turnover. Property, plant and equipment turnover, sales divided by property, plant and equipment value. Sales divided by property, plant and equipment value. Right. Now you should practice all these with Excel. Because when you are physically available in the university, we are going to do analysis for a real company. Right. Then I'm not going to explain any of these ratios. So you should practice now with Excel. Then when you are physically available in the university, we are going to do a analysis. Right. So I'll be giving instructions before coming to those lectures. I'll be giving instruction. These are the things you should get ready before the lecture. So there we are going to discuss only the analysis part. So I'm not going to explain these calculations. We are going to discuss only the analysis part. Right. Now you see sales divided by property, plant, equipment value. Sales divided by property, plant, equipment value. Right. So in this formula, you can fix the sales value in row wise. You press F4, only the row wise. Only row wise. So dollar mark only for 57, your row number, sales row number. Dollar mark only for sales row number. Then you can drag and copy to the rest of the sales. You can drag and copy to the rest of the sales. So we'll round up to 2 decimals. Right. Now these are the turnover values. These are the turnover values. So you don't need to interpret all these turnover. So you pick the important ones. You pick the important ones. Now, if you see intangible assets turnover, you see it has been increasing. You see intangible assets turnover. You see it has been increasing. So why it has been increasing? If you see the financial statement, you see intangible assets amount intangible assets amount is declining. You see in the financial statement, intangible asset amount is declining. So that because of impairment. That because of impairment. You know, intangible assets are patent, your company's patent, externally acquired brand, trademarks, your research development costs. So they are subject to impairment. Now you see intangible asset value over time decline. That usually happens because at the end of each year, you have to do an impairment test and do necessary adjustment for impairment. So usually we expect this kind of behavior for intangible assets. Now you see, while intangible assets value declining, your sales value you see increasing. 2019 sales 9,421, 2021 sales 11,101. So when that happens, you see turnover increasing. Turnover increasing. So this intangible asset turnover is not that important because usually we expect intangible assets turnover should be increasing. But if you see property, plant and equipment turnover, that's important. That's important for our analysis. This is important for our analysis. Then inventory turnover is important. Turnover ratio for our analysis. Debtors turnover, important ratio for our analysis. Cash turnover, important. Working capital turnover is important. Right. So you pick the important ratios, relevant ratios, and do the analysis. Right. Now for this company, these are important. Property, plant and equipment turnover, inventory, debtors, cash, and this working capital turnover. Working capital turnover. Right. Now let's see movements in these turnover ratios. Now if you see the operating assets turnover, you see it's in a declining trend. Operating assets turnover is in a declining trend. Now if you study the movements of these turnover ratios, so you can find out why it has been declining trend. You can find out why it has been in a declining trend. Right. Now you study these turnover ratios. You see a profit, plant and equipment turnover declining. So inventory turnover also declining. You see a 2019 10.93 that declined to 6.04 in 2021. So debtors turnover also declining. Now you see for this company, these are major assets. These three are major assets: property, plant and equipment, inventory, and debtors. So these turnover values are declining. As a result, company experience a declining trend in operating assets turnover. You see, company experience a declining trend in the operating assets turnover. Right. Now we have analyzed the reasons. We have analyzed the return on operating assets, and we have found major reasons for the changes in return on operating assets from one year to the next year. Right. Then we'll analyze ROE, return on equity. We studied ROE analysis. You can remember, we studied ROE analysis. Now first calculate ROE, return on equity, return on equity. So your net income divided by total equity. So from the profit for the period, you have to deduct any preference dividend. For this company, all shares are ordinary shares. We don't have preference shares for this company. Then return on equity, profit for the period divided by total equity. Return on equity equal profit for the period divided by total equity. So equal, in your financial statements, you see a profit for the period divided by total equity. You see total equity here. So this is ROE. ROE. Right. So you can make this to a percentage. ROE. Now you see ROE in a declining trend. You see ROE is in a declining trend. Declining trend. Now we need to analyze ROE. So we studied ROE analysis. We studied ROE analysis. So you can remember this. ROE analysis. You can remember this. Return on operating assets. So one major reason for changes in ROE is return on operating assets, ROA. And the other one is leverage effect. Leverage effect. You can remember we divided leverage effect into two. One is benefit of lower finance cost. The other one is tax savings on leverage. Tax savings from leverage. Then total of these three equal to ROE. Total of these three is equal to ROE. Right. Now we'll do the same. We'll do the same analysis. Right. So we'll do the same analysis. Right. So we'll take ROA. Then we'll take leverage effect. Now we know the ROE. So we'll take ROA, return on operating assets. Return on operating assets. ROA. So we have calculated ROA. So you can link these values. ROA. You can simply take the values here. You see ROA is declining. You see ROA is declining. As a result, ROE is declining. ROE is declining. Right. Then you calculate the leverage effect. So we know we need the borrowing cost. We need the interest rate or borrowing cost rate. So benefit of lower finance costs. You take ROA, return on operating assets, minus the borrowing cost rate. Borrowing cost rate. ROA minus borrowing cost rate multiplied by debt to equity ratio. Debt to equity ratio. So we have to find out borrowing cost rate. Borrowing cost rate. So we'll calculate here. Net borrowing cost rate. Net borrowing cost rate. So here why I'm saying net borrowing cost is, if you see the financial statements, now this is important. You borrow some money, you see, under financial liabilities. You issue debentures. You borrow money through bank loans, leases. In the meantime, you have investment in marketable securities. You see, you borrow money. In the same time, you have investments in marketable securities. Then what happens is, if you see the income statement, you have finance costs and you have finance income, interest income. The difference between finance cost and interest income is net financial expense or net expense relating to borrowings. So we'll use that net expense to calculate the borrowing cost rate. Borrowing cost rate. So this net finance expense, net financial expense divided by net financial liability. Net financial liability. So we'll calculate net borrowing cost rate. Net borrowing cost rate. So this is how you calculate net finance income, net financial expense divided by net financial liability. Net financial expense divided by net financial liabilities. So that's the interest rate, net interest rate. So equal net financial expense in your reformulated financial statements, net financial expense 32 in 2019, net financial expense 32. Now you see this is in negative value. Then you put minus 32 minus net financial expense. You put minus divided by net financial liability. Net financial liability. So you get a borrowing cost rate. So if you convert to a percentage, 8.36. 8.36. Net financial expense divided by net financial liabilities. Then you can copy the same formula to the rest of the sales. You can copy the same formula to the rest of the sales. Now you get the net borrowing cost rate. You see, company has borrowed money at these rates over these 3 years. Then you calculate the leverage effect, ROA minus borrowing costs, ROA minus borrowing cost. So ROA we have, these are ROA, these are borrowing cost rate. So ROA minus borrowing cost. ROA minus borrowing cost. Now you see the difference between ROA and borrowing costs is declining. When it comes to 2021, it has become a negative value. So what does it mean? In 2021, you see borrowing cost is larger than the return generated from operating assets. You see 2021, borrowing cost 12.94, which is larger than return generated from operating assets. Return generated from operating assets. Right. Now you see company has borrow money at a rate larger than return generated from operating assets. So at the end, what happens is company there is nothing remains to shareholders, because entire return generated from operating assets has gone to the lenders, your long-term creditors. Entire return on operating asset you have paid for borrowings. So what happens is nothing remains to shareholders. Nothing remains to shareholders. So that's the meaning of negative value. This negative value. Then a debt to equity ratio. Debt to equity ratio equal, in your financial statements, net financial liabilities divided by equity. Net financial liabilities divided by equity. In your financial statements, net financial liabilities divided by equity. You have debt to equity ratio. So 1 minute, please. Right. So net financial liabilities divided by equity. So debt to equity ratio. So if you multiply this ROA minus borrowing cost by debt to equity ratio, you get the benefit of lower finance cost. So this is multiplied by debt to equity ratio. This is multiplied by debt to equity ratio. So you get benefit of lower finance cost. Now, if you see 2019 and 20, if you see 2019 and 20, you see your borrowing rate is lower than ROA. You see 2019 and 20, the borrowing rate is lower than ROA. The meaning is company borrow money at a lower rate and generates higher ROA. So assets have been financed at a lower cost. Assets have been financed at a cost lower than return generated from those assets. So 2019 and 20, company has positive leverage effect. But that positive effect has declined. You see a positive leverage effect in 2019, 1.16. That declined to 0.46% in 2020. But if you see 2021, you see leverage effect is negative. You see 2021, leverage effect is negative. You see a borrowing rate almost 13%. You see borrowing rate almost 13%. But assets generates only 12.3% return. Assets generate only 12.34% return. You see a return generated from assets is lower than the borrowing rate. Return generated from the assets is lower than the borrowing rate. Therefore, leverage effect is negative. So in 2001, company's finance costs has been higher than the return generated from the assets. The meaning is nothing remains to shareholders. There is no leverage effect, positive leverage effect to shareholders. Right. Then we can analyze the second part. Tax savings from leverage. Tax savings from leverage. So these are the three values we need to calculate the tax savings from leverage. You need an interest rate, that is the borrowing cost rate. So you can say interest rate or borrowing cost rate. Borrowing cost rate. So we have calculated. You can link the values. We got borrowing cost rate here. You can take the relevant values. Tax rate, here we should take effective tax rate. Effective tax rate. You can remember we got effective tax rate last time. So you can link those values in your adjusted financial statements. You see somewhere effective tax rate. You see effective tax rate or the previous one, previous financial statement, those adjustments, under those adjustments. So we got effective tax rate. In the adjusted financial statement, you see effective tax rate. So you can link the values. Don't type 30%. Don't type 30%. You link the value. Equal, you put that cell reference. Then debt to equity ratio, we calculated earlier. So when you multiply these three, borrowing costs multiplied by effective tax rate multiplied by debt to equity ratio, you get the tax savings from leverage. Tax savings from leverage. Borrowing costs multiplied by effective tax rate multiplied by debt to equity ratio, you get tax savings from leverage. Tax savings from leverage. Tax savings from leverage. Then ROE is equal to total of these three. Return on operating assets, return on operating assets plus leverage effects. You take the total of these three. Return on operating assets plus leverage effects. These two leverage effects. So return on operating assets plus these two leverage effects. These two leverage effects. You get ROE. Now you see this is same as the ROE you calculated earlier. You see this is same as ROE you calculated earlier. Right. So it's almost same. Almost same. Now you can analyze these changes. So we have already analyzed return on operating assets. Now you can analyze leverage effects. You can analyze leverage effects. Right. You see the difference between ROA and borrowing cost declining. So company has been getting lower benefits from finance cost. You see difference between ROA and borrowing costs declining. So company has lower benefits from finance cost. That benefit has been declined. But tax savings on leverage has been increasing. Because gradually over the time, finance cost has been increasing. You see, borrowing rate has been increasing over time. You see, borrowing rate has been increasing. Therefore, company has higher tax savings from leverage. Higher tax savings from leverage. Right. Now, from this analysis, you can find out the reasons for the changes in ROE. Reasons for the changes in ROE. Right. Now, this is about profitability analysis. Profitability analysis. They can then you can insert another sheet. You can do a liquidity analysis, or you can do credit analysis. You can say a sheet name is credit analysis. Credit analysis. Credit analysis. So under credit analysis, you can remember. So you have to do a liquidity analysis. You have to do a liquidity analysis. And you have to do a solvency analysis. So you can do liquidity and solvency analysis. So you know liquidity ratios. So you can first calculate under this credit analysis those liquidity ratios. So you can say first liquidity analysis. You can take 3 years. You can take 3 years. So under that you can say liquidity analysis. Liquidity analysis. So you can calculate current ratio, quick ratio, and those working capital ratios, inventory holding period, debtors collection period, then creditor settlement period, right? So you can analyze these liquidity ratios. Then you can do solvency analysis. You can do solvency analysis. Solvency analysis. So you can calculate solvency ratios. Debt to equity ratio. So we have already calculated debt to equity ratio. So you can take that ratio. Debt to equity ratio. Debt to total assets ratio. Debt to total assets ratio. Interest coverage. Interest coverage.
So likewise, you can analyze solvency ratio. So by doing liquidity and solvency analysis, you can see how far company has been able to pay liabilities. So with this analysis, you can find out how far company has been able to pay liabilities. Right. So that's about credit analysis. You can do it. You can do it. Right. Now here we have learned that the financial statement as given is not suitable for the analysis. So we need to do accounting analysis before the financial analysis, before doing any profitability or any credit analysis, before any financial analysis. So we have to do accounting analysis. So that's why we adjusted financial statements. So we adjusted given financial statements. Then we have got adjusted financial statements. Now these are adjusted financial statements. Then we have reformulated. We have reformulated the adjusted financial statements. So we have reorganized. We have reorganized financial statement items. Then we have done the analysis for these reformulated financial statements. So this is what happens in practice. You don't do analysis for the given financial statements. You see whether any adjustments are needed. Then after doing the relevant adjustments, you can start the analysis. You can do the analysis. Right. So these are the learning points. Learning points in this tutorial. Now what you have to do is, you do a credit analysis, then you try to prepare a 5-page report about company's profitability and company's creditworthiness. Right. So after completing the credit analysis, you prepare a 5-page report. You prepare a 5-page report about company's profitability and company's creditworthiness. Because practically, you have to produce a report to the company's management. You have to produce a report to the company's management. Right. So you need that skill. In addition to the analysis skill, you need a report writing skill. So at the end, based on your analysis results, so you need to produce a report to company's management about, for example, company's profitability or company's creditworthiness. Now we have done profitability analysis. So you can do credit analysis. You can do credit analysis. Then you produce a report by incorporating your analysis results. So you prepare a 5-page report to company's management about company's profitability and creditworthiness. So creditworthiness means how far company has been able to pay liabilities. Creditworthiness means how far company has been able to pay liabilities. Right. So you try to prepare a report because that report writing skill is needed. Right. So that's about today's lesson. Next time we can do analysis of operating activities. There are certain things you should learn. Right. Any questions? Any questions? Right. Then we'll stop for today. See you next time.
Thank you, sir.
You're welcome.